Hi, everybody, and welcome to Chapter 9, Video number 1. Here we're going to look at the acquisition and disposition of property, plant, and equipment, PP&E. Okay, after we go through this chapter, you're going to be able to identify property and plant and equipment, its related costs, discuss the accounting problems associated with interest capitalization, explain the accounting issues related to acquiring and valuing plant assets. Then we're going to describe the accounting treatment for costs subsequent to acquisition. And finally, describe the accounting treatment for the disposal of property, plant, and equipment. So as we preview Chapter 9, here we're going to look at the acquisition of property, plant, and equipment, the cost of land, cost of land improvements, cost of equipment, cost of buildings, and how we retire assets and their costs and obligations. Then we're going to look at interest costs during construction. What qualifies for that treatment? The capitalization period, the amount that we'll capitalize, and some other issues. And then we'll continue by looking at deferred payment contracts, lump sum purchases, issuing stock, exchanges of non-monetary assets, and other valuation methods. Then our costs subsequent to acquisition include additions, improvements and replacements, rearrangement and reinstallation, repairs, and then a summary. And then, as we dispose of property, plant, and equipment, how we sell plant assets, and perhaps even some involuntary conversions. All right, let's get started with the meat of the chapter in identifying property, plant, and equipment and its related costs. What are property, plant, and equipment? They're assets of a durable nature. Other terms that we use are sometimes called plant assets, or as I often use the term, fixed assets. We use these assets in operations. We're not in the business of reselling them. They're long-term in nature and usually depreciated, except for land, of course, which we don't depreciate. And then they have what we call physical substance, meaning that you can touch them. They have substance that you can touch. And examples are land, building structures, office, factories, warehouses, and equipment, which include machinery, furniture, and tools. All right, historical costs. That consists of the acquisition price plus sales tax, but also what students often miss is they include the costs associated and incurred in bringing the asset to its location, and such as freight and shipping costs, and other costs incurred getting the asset ready for its intended use, such as installing it, or testing it, or insuring it, that kind of thing. We use historical cost for valuation. Historical cost is reliable, and companies should not anticipate gains and losses, but should recognize gains and losses only when the asset is sold. All right, let's look at land. The cost of land includes a variety of different things to get the land ready for its intended use. Of course, 1, the purchase price. 2, closing costs, such as title to the land, attorney's fees, commission to real estate agents, and recording fees. Number 3, sometimes we have to grade, fill, drain, or clear that land. Those costs are included. And then number 4, if we have to assume any liens, mortgages, or encumbrances on the property from the prior owner. And lastly, number 5, additional land improvements having an indefinite life. Now, those land improvements we're not going to depreciate them if they have an indefinite life. Okay, let's look. Improvements with limited lives, such as private driveways, walks, fences, parking lots, we record those as land improvements and we do depreciate those. And a couple of other notes: land acquired and held for speculation is classified as an investment. Land held by a real estate concern for resale should be classified as inventory. So those would not be long-term assets. All right, let's take a look at an illustration of purchasing some land. Here is Tesla, and a Tesla acquires some property on the outskirts of Austin, Texas, for a factory site. Tesla paid $2 million for the site and agreed to assume unpaid property taxes of $42,000, as well as an unpaid mortgage loan of $210,000. The city also assessed the company $38,000 for sewers, street pavement, and water mains. Tesla will be using the property site as a manufacturing facility for its new Cybertruck. Additional costs related to the properties are shown here. We have real estate commissions, we have title search, we have costs related to demoing the old warehouse, we have salvage value related to the demolition of the building, and costs of surveying and grading the property, as well as the cost of landscaping. This has a useful life of 20 years. So, what amount should be reported for the cost of land and any land improvements? Okay, let's look at that. The land costs are going to include the land purchase cost, the assumption of property taxes, the assumption of unpaid mortgages, the assessment of sewers, pavement, and water main, real estate commissions, title insurance, demolition costs related to the old warehouse, offset a little bit by the salvage value related to the old warehouse. Oftentimes, for example, you have copper that's included in the wiring that can be sold when the old warehouse, in this case, is demoed. And then the cost of surveying and grading the property here. So the total cost of land, $2,453,000. Now, land improvement costs, here's our cost of landscaping here at $101,000 with a limited life. And then the journal entry to record these transactions are going to be as follows. We'll have land, $2,453,000, land improvements, $101,000, and our cash used to pay for that at $2,554,000. Okay. Equipment. Cost of equipment is going to include all the expenditures incurred in acquiring the equipment and preparing it for use. These costs are going to include the purchase price plus any sales tax, freight shipping costs, insurance during the in-transit paid by the purchaser, and assembling, installing, and testing the equipment. Not included are going to be recurring costs related to the equipment, such as vehicle licenses, accident insurances on company trucks and cars. All right, an illustration on trucks here. Assume FedEx purchases its first battery-powered delivery truck on January 1 at a cash price of $22,000. Related expenditures are sales taxes, $1,320, painting and lettering, $500, vehicle license, $80, and a 3-year accident insurance policy for $1,600. What journal entry would FedEx make to record the cost of the truck? Well, what we're going to do is we're going to include the cash price, the sales taxes, the painting and lettering. I'll go back. That would be here, here, and here. But the remaining costs, the FedEx is going to treat the cost of a motor vehicle license as an expense here, and the cost of an insurance policy as a prepaid asset here. And so now this is how our journal entry would look. Here's our equipment dash trucks, $23,820. License expense, $80. Prepaid insurance, $1,620 for total cash out of $25,500. Now let's look at some machinery. Assume that they purchase a new commercial freezer at a cash price of $50,000. Related expenditures are sales taxes for $3,000, insurance during shipping, $500, and insurance and testing, $1,000. What journal entry would Trader Joe's make to record the cost of the freezer? Well, we have our cash price, $50,000. We have our sales tax of $3,000. We have insurance during shipping, $500, and installation and testing, $1,000 for a total cost of factory machinery, $54,500. So our journal entry, very simple. We debit equipment, $54,500, credit cash to pay for it, $54,500. If we look at the acquisition costs here, purchase prices, what it includes, this summarized nicely what we just went through. Construction by an independent contractor, we're going to have several different kinds of costs there in the building. Contract price, architectural fees and building permits, excavation costs, third-party costs directly attributable to the construction, such as advisory valuation cost. I once had environmental analysis done. That would be part of it. Interest on construction financing during the construction period. We'll discuss that a little later in this chapter. And sometimes we construct things ourselves, and we'll have materials, labor, and overhead directly related to that construction. We're going to capitalize that labor and materials and overhead. A pro rate of portion of fixed overhead, and then interest on construction financing during the chapter. We will discuss that further. The purchase, if we should actually purchase a building, we're going to have a purchase price, closing costs, attorney's fees, title insurance, real estate agent fees, any back taxes or mortgage on the property, cost of remodeling or repairs to ready the building for its intended use. Okay, that looks like a good place for us to stop this video. And when we return, we'll take a look at building costs in further depth with this illustration. Until that time, bye for now.